You know, trading options can sometimes feel like trying to sail through a storm with no compass. But what if I told you there's a kind of secret language, a set of tools that pro traders use to see what's really driving an option's price? Well, today we're going to decode that language. Just imagine for a second. What if your investments came with a full dashboard? I'm not just talking about a price tag. I mean real gauges for speed, warning lights for hidden dangers, maybe even a radar for market storms. That would totally change the game, right? Well, for options traders, that dashboard is very, very real. And this gets right to the heart of why that dashboard is so important. A stock's price is, relatively straightforward. It's driven by things we can see and track, like how the company's doing. But an option? Oh, it's a completely different beast. Its price is constantly being pushed and pulled by these invisible forces, the unstoppable ticking of the clock, and the ever-shifting mood of the market. So how on earth do traders manage all that complexity? Well, they use a special set of tools that act as that very dashboard we just imagined. It's their way to measure and manage all those different risks at the exact same time. And these tools, they're called the Greeks. Yep, named after letters from the Greek alphabet like delta, gamma, theta, and Vega. Each one is like a specific gauge or a warning light on our dashboard, giving traders a clear mathematical picture of what's happening to their position. So, let's start with the big one, the absolute cornerstone of options risk management, delta. The easiest way to think about delta, it's your speedometer. Delta's job is simple. It tells you exactly how sensitive your options price is to a move in the actual stock. It's your speedometer. It tells you how fast your options price is going to change when the stock price moves. Let's see it in action. Okay, so let's make this super practical. Imagine the stock your option is based on goes up by exactly $1. And let's say your option has a delta of 0.40. So what happens? Boom. With that $1 move in the stock, your options value is expected to go up by 40 cents. Simple as that. Your speedometer, delta, told you exactly how much to expect. But wait, there's more. Delta has this other really cool trick up its sleeve. Traders often use it as a quick and dirty way to estimate probability. So a delta of 0.30 suggests there's roughly a 30% chance the option will be profitable at expiration. It's like a powerful 2-for-1 gauge. Okay, so we've got our speedometer. But what about those other invisible forces we talked about? Now we need gauges to measure the powerful effects of time and, the general mood of the market. First up is Theta, which is basically the enemy of every option buyer, time decay. Every single option has an expiration date, and as that date gets closer, the option just naturally loses some value. Theta tells you exactly how much value is just dripping away every single day. The best way to think about this is like a melting ice cube. Every day that passes, a little piece of your options value just melts away, and you can never, ever get it back. And here's the crazy part. That ice cube doesn't melt at a steady pace. Look at this chart. The decay accelerates like mad. With 25 days left, this option is losing about $45 a day. But fast forward to just 6 days left, and that decay has more than doubled to over $93 a day. That's Theta kicking into high gear. All right, next gauge on our dashboard, Vega. Now, this one isn't about the stock price or about time. This is all about the market's mood. Vega measures how an options price reacts when people expect things to get wild. In other words, to changes in volatility. The perfect analogy for Vega is a storm forecast. When the weather forecast calls for a hurricane, what happens to insurance premiums? They go way up, right? It's the exact same idea with options. When the market expects big price swings, a financial storm, the price of options goes up. Vega tells you by how much. Okay, so we've got a gauge for price speed, another for time decay, and one for market storms. But there's one more key piece that ties it all together. Let's complete our dashboard. And that final piece is gamma. If delta is your speedometer, then you absolutely have to think of gamma as your accelerator pedal. It tells you how quickly your speedometer itself is going to change as the stock price moves. A high gamma means your foot is on the gas. Your option sensitivity can ramp up or down really, really fast. So here it is, the whole shebang, the full dashboard. You've got delta, your speedometer, gamma is your accelerator, theta is the fuel gauge, and it is always ticking down. And Vega is your weather radar, constantly scanning for market storms. The key is they all work together. A trader has to watch everything at once. And look, this is not just some boring theory, right? As the source material puts it, understanding how the Greeks work together can mean the difference between consistent profits and unexpected losses. This is about seeing the entire picture, not just staring at a single price on a screen. Which really just leaves one final question for you. When you're looking at an investment, are you just looking at the price tag? Or are you actually trying to see the full dashboard of risks that are churning away right underneath the surface?